Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Great pleasure to welcome everyone to a new episode of This Week in Intelligent Investing. We have a great conversation ahead, and Elliot, I'll ask you to get us started.
All right. Thank you, John. So today I want to talk about a specific chapter from the book Setting the Table by Danny Meyer. Many of you might know who Danny Meyer is because he's got many fantastic restaurants in New York City, Manhattan in particular, but also Shake Shack, which is a global phenomenon. I absolutely love those burgers, and making me a little hungry here this morning thinking about it. But anyway, here's the point. I also want to thank actually Palmetto Capital. He's the one who sent me this book and encouraged me to read it. I think it's about way more than just Danny Meyer's restaurant, and obviously it was intended to be. The subtitle is The Transforming Power of Hospitality in Business. So, he really wanted to speak kind of transcendentally about business in general, especially hospitality. But I think there's some good lessons for us in investment. So I would strongly recommend reading the book. Danny Meyer's concept is called Enlightened Hospitality. But, it's this one chapter called Constant Gentle Pressure, which I just love the title. It really resonates with me. It stood out. And to me, it was like the meat of the book. So, first off, like high level, I think it's about having a growth mindset and pushing things forward constantly at all times, but gently. And in some ways, I really think it's like the exact opposite of the move fast and break things we hear about from Silicon Valley. Because, in most contexts, breaking things is not ideal. And when you break things, especially for some of your stakeholders, there are very real consequences to doing this. And so, I don't love this idea of constant move fast and break things. I think it's, maybe contextually relevant to one specific company or a couple at a single point in time. But in general, in most things where you're really working with customers on an everyday basis, constant gentle pressure as your growth mindset, where you want to get better at everything you do without breaking things. To me, that's kind of a better, higher ideal. So, the chapter starts with this idea of know your center. And to me, what that means is have a purpose, have a mission, know your essence, know who you are. That's your foundation. And when you're applying this constant gentle pressure, you never leave this foundation. It's like your highest calling, right? It's your first principle. And so, everything you do is built upon that. And I think that's true of being an investor, of having an investment strategy, of building an investment firm. You have to define yourself. You have to know who you are. You have to know what you stand for, like which ideals, which principles, which kinds of investments you will make, and which, everything else that you absolutely won't do, will not do, never do. He talks about being imaginative in solving problems. This fact that everyone, every business, everything you do has problems, right? I think there's too much that we talk about in business analysis in general that doesn't talk about the ethos and the strategies and the paths you take when problems arise, about when you're an investor for the long term, what you do when, right now, or maybe not even right now, because we're a week into what is the opposite of this. But at times, you think and look and feel like everything's going up and to the right, but there are speed bumps, there are hiccups, there's like tough times along the way. And, how you handle them, how you deal with them, how you adapt to the challenges is extremely important for who you are, what you are, and how you do as a business. This concept of, he talks about leadership a lot in this chapter. He mentions it's a two-way dialogue. You have to compromise. You have to have a willingness to share power. This is something I've noticed in great businesses and a lot of my favorite businesses. And I think it's something that, Buffett talks about a lot too, in part of the beauty of the Berkshire model. You have to decentralize. You have to have people you're willing to delegate to. Those people have to be capable of making extremely important decisions, and they have to have a trust that, you as their leader will kind of take some of the responsibility, some of the blame for when things don't go well, but also they're empowered to do well. I think empowering people is one of the key ingredients behind businesses that I truly love versus those that don't. I think, especially in certain hedge funds, I've seen a model where you want to chew up and spit people out after 2 years to a business program, and they don't necessarily learn. They don't feel empowered along the way. Like, I believe deeply in empowering people. So yeah, Danny Meyer gives his specific lessons on hiring managers. He talks about looking for people with infectious attitudes, self-awareness, that strive toward long-term success, not short-term success. Feed people with a sense of abundance. Don't make people feel like, they have to be too tight on everything. It doesn't mean don't be conscious of budget and don't, be smart about what you do and don't spend on, but, make people feel like there's an environment where they take part in the success too, where it's shared. And it doesn't just all go to the owners. He calls his employees his single most important stakeholders above and beyond his investors and his customers. And there's this sense, I don't hear this very often, though there are a few special companies like Costco is one that stands out in this sense. When your employees truly feel comfortable, confident, and content, like you have an environment where your customers and your investors stand to disproportionately benefit. And I think that's an interesting kind of different mentality than we often hear. He talks about build trust, not fear, collaborate and empower. So recently I was engaged in a thread with Paul Enright on Twitter. He comes out of the long short hedge fund world, and I think he had some great stuff to share. I started this kind of one tweet of generalists for specialists, and I had my generalist manifesto, one of the early podcasts here. But deeper down in this thread, I gave a few nuggets on how I think about some of these things and how I like to approach this. I made my first hire in March of 2018. It feels like it was a lot more recent 2019. So 2 years ago, 2 years of having someone working for me for the first time. And, I wanted to approach it in a very specific way. And I think it kind of fits this framework. One of the first things I wanted to do was hire for a skill set to round out my own and my firm's weaknesses. So I targeted someone who had capabilities that I knew were not my strengths. And then what I wanted to do is I wanted to make sure the person was empowered, them to feel like they had ownership in mentality. I wanted them to know that they shared in success, that they had an opportunity to explore their own interests and improve their sense of purpose. But I also, my job as a manager was to kind of identify the analyst's strongest skill, identify their weakest skill, empower them in their strongest area, but teach to their weakness. And, I think that's hopefully where, coming from a non-Wall Street mentality, not having grown up in a firm that had its own processes, I could bring a different mindset to our industry. And I thought it was, kind of a little, I hope, I aspire to it being kind of like how Danny Meyer thinks about these things. So a lot there. I'd love to hear what you guys think, how it resonates with you in both the investment world and in terms of businesses you look to and try to own for the long term. And open it up.
Yeah, it's funny. Somebody gave me that book as well years ago. I don't know, it was at least 3 or 4 years ago now. And I haven't read it yet because I have so many books I want to read, and it's been sitting there, and I've had this very stupid judge a book by its cover attitude. Like, what do I have to learn by a book about hospitality and restaurants by this guy I've never heard of? So shame on me. This will definitely bump it to the top of the list. It sounds really, really interesting. And I couldn't agree more. And there's a book along the same lines that is it pertains directly to investing. It's called There's Always Something to Do by Peter Cundall. And he's a Canadian fund manager who's unfortunately passed away years ago now. But, he had a lot of the same ethos, and, the mantra of constant gentle pressure was very similar to how he would conduct his research and the attitudes you just described about staying within your foundations and empowering the people around you. That was very much how he ran his business. He had an unbelievable track record for a long time and was very much a global investor. Interestingly, one of the things he did was every year over the holidays, he would look at what the worst performing stock market in the world had been, the worst one or two maybe. And then early in the new year, like in February, he would take a trip for 2 or 3 weeks and go visit that country and just figure out what was going on. So if the prior year, the worst performing stock market had been Vietnam, off he was to Vietnam. And he would then build this unbelievable network of people that he had empowered to do great things for him and with him, and it was just a fascinating way of going about it. I don't think it would work for me, but it certainly was a effective and fascinating way for him to go about it. So that was one thing that jumps to mind. And I agree, there's a lot of other things here that are the hallmarks of great companies. I mean, decentralization kind of gets a bad rap, I think, these days because of Wells Fargo and GE. And to me, that's really the wrong lesson to draw from Wells Fargo and GE. I mean, those were a lot of things went wrong with those two companies, and it really didn't pertain to the fact that management gave too much authority away from headquarters, right? I mean, and so now bringing in a chief department assistant to the regional manager compliance guy is not going to help solve that problem, whatever the problems were, and there were plenty of them. So I totally agree. So, I mean, one of the things I'm always thinking about then in these situations, both for the people I work with and for the businesses I'm looking at, is then how do you actually, what are the most effective structures? How do you formalize this process? How do you actually go about incentivizing people? How do you actually apply that constant gentle pressure? How do you set up mentorship opportunities, and how do you actually act as a mentor and a mentee when the time is right? I mean, I wish I had better answers for this in a limited sample set. All I can tell you is I've gotten really, really lucky, and just been fortunate enough to be hired by and hire some absolutely tremendous people where I've been exceptionally lucky to work with them. My partner, Kristen Hartman, who runs pretty much all of our business, just does an absolutely phenomenal job. And I don't think I could have ever improved on it one bit. And I don't know what I did to deserve it other than be in the right place at the right time. So I think that's a huge part of it. And there's, so everything, I mean, I will say one thing I've been extraordinarily cognizant of there is to just be, as the old phrase goes, to delegate to almost the point of abdication. I mean, she does a great job, and I just want to be as, hands off as I possibly can in that world. It would just be totally counterproductive to be a micromanager. So anyway, those are my quick thoughts. John, what about you?
Yeah, I would say when I hear constant gentle pressure, it actually reminds me a little bit of the Japanese concept of Kaizen, which I think literally means change for better. It's often described as a philosophy of continuous improvement, and it kind of goes back to the Japanese exporters and manufacturers of the 80s. They were always just looking for that next little improvement, as opposed to, again, that philosophy of move fast and break things. In terms of how this, and by the way, in terms of Kaizen, there's a great book called Matsushita Leadership by John Kotter, and it talks about Kensuke Matsushita, who basically is one of the fathers of that philosophy. There's also, you can bring sports into this. I've watched some documentaries on people like LeBron James, Michael Jordan, Tom Brady. Those guys always seem to be applying that constant pressure on their teammates. I think Jordan was doing that to everyone on the Bulls because they understand they're not going to win championships if their teammates are not elevated to another level. And so I think when it comes to managing people, it's really a lot of it is about elevating their own expectations of themselves, because a lot of folks don't have this, obsessive mindset that of this search for excellence or perfection. A lot of folks are just content with doing a good enough job, let's say. So you got to always push them a little bit to expect more of themselves, kind of to be detail oriented, and to trust themselves more and to grow. But you got to do it in a way that's not a fire drill kind of way. I mean, I remember when I was an analyst in investment banking, it wasn't gentle pressure. It was like, we got a new fire drill today, and you got to crank out this slide deck and whatnot. And that's not the kind of environment I think we're talking about. Now, how does some of this apply to investing? I think we can also apply gentle pressure to ourselves to kind of push ourselves to always evaluate and reevaluate our own investments, our own decisions, and to ask probing questions of ourselves. Did this work out really because my thesis was right, or did I just get lucky? And then also really understanding the companies enough that we would be comfortable buying the whole thing. I think that, that goes back to pressuring ourselves a little bit to kind of go into the details and really make sure we understand the business and are not just buying into some investment thesis that we read somewhere.
I'm glad you mentioned that, John, just real quick to circle back, because that was the one thing I really took away from There's Always Something to Do, which I should have mentioned in my first set of remarks, was that there is always something you can improve. There's always some progress you can make. So it's very common, I think, for certain investors, and I fall into this trap as a relatively concentrated investor, and I don't short anything anymore. So, it can look like if the market's doing something goofy, or if I feel like the things that I can understand are all too expensive or whatever, it's very easy to sit there and tell yourself, I'm just kind of sitting here waiting. And it's like, that's always the wrong answer. There's always something to do. And that was something that Peter Cundall was always very good at, was finding these areas to apply that pressure to himself, not to push beyond his circle of competence, not to go out and just do something for the sake of it. It's not about trading to create activity and busyness. It's not about, doing something reckless and stupid when you're uninformed. It's about always pushing to say, okay, we've done this, we own this, what can we do better? And there has to be some other area of opportunity out there that's just waiting for me. And often used to talk about this, right? Turning over the most amount of rocks, right? And the world has changed, right? I mean, the kind of rocks he turned over back then when you'd go page by page in the Moody's manual or go hunting around for these little micro caps. I mean, that world has changed to a certain degree, but the point certainly remains valid that there's always something to do out there, and you just have to keep that pressure on yourself every day.
Yeah, I love that title. I love that concept. I think it's like of the things that defines myself when I was stuck in this world of wanting to get into finance, but having been in law and sports and not really having my angle, I was like, what's the one thing I can control that I can do? It's spend at least a little bit of every day trying to get better, trying to improve a skill. And what that's turned into is now what I do at the beginning of each year. I kind of pick one specific area that I feel like I want to enhance my capabilities in. And I spend at least a little bit of every day trying to build and or sharpen that specific skill. So every year it's something a little different. This year for myself, my goal is to get better at data analysis and piecing together data that I could use in my investing process. And, it takes some effort. I've had to look at Tableau more than I, had ever in my life. And, hopefully by the end of the year, I could say I've done something that meaningfully improves my abilities as an investor. You don't necessarily know off the bat whether that'll be the case or not. But just the fact that I set aside a little time each day, I think is something important to me. I think we've all said on this podcast, and I think it's part of why we like doing this together. And I think all of us have this mentality, always try to make yourself better tomorrow than you are today. And that's constant gentle pressure, right? It's, the compounding benefits that accrues over a very long term is hard to see from today to tomorrow. But, when you look back at yourself 5 years ago, you really see a huge difference. When you look back a decade, it's even more so. John, I love that you mentioned, I'm so glad you brought up Matsushita Leadership, because you recommended that book to me before we started the podcast. And it, really resonated, really meant a lot. And, I totally see the parallel right on. And in this concept of decentralization and delegation in management, I think that's truly, before I really appreciated Jack Dorsey at Twitter, I had to learn about him at Square. And that's where it came about clearest, that what he's most into and what he most fundamentally believes in is this concept of, hiring, empowering, and delegating. And one of the things I've noticed is that when things go wrong in Jack Dorsey's company, he's never thrown someone under the bus. He said, this is my fault. The buck stops here, right? Like I'm the one that takes accountability. And, that's real leadership. And I think it's rare. And I think only a few special companies truly pull it off exceptionally well. When you think of the Kaizen companies, Danaher's culture, DBS, and all that. Like it definitely, there are a few interesting examples, and I think the successes are truly standout in this world.
Yeah, it's funny too, since you mentioned some tech titans, two things that jumped out for me is one, going back to your first comment. I remember, I'm pretty sure it was Bill Gates. It was attributed to Bill Gates, but this was a long, long time ago. But he said people often way overestimate what they can get done this year and way underestimate what they can get done this decade, right? So even if he didn't say that, or even if it wasn't quite exactly those words, I think the point very much stands that, you can't get overwhelmed by everything you have to get done in something like one trip around the sun. That can be an arbitrary and too short of a constraint. But if you apply this kind of pressure to yourself over a period of several years or something like a decade, like you said, Elliot, I mean, it's astounding how much you can learn over 5 years or over 10 years and how much progress you can make in a skill or a knowledge base or something like that. And then secondarily, I mean, the whole concept of move fast and break things. I mean, look, I've tried to make somewhat of a rule, not hard and fast, but pretty close, to not criticize by name on this podcast. But you're obviously referring to Mark Zuckerberg and Facebook, because he said that many times. And look, I'm a huge critic of the company in a lot of ways, and I think this is very symptomatic of a lot of what's wrong with that company. And someone, again, I don't even remember who I should attribute this quote to, said, but it was something along the lines of, this is what happens. This result with Zuckerberg and Facebook is what you get when you replace civics with computer science. And I think that hits exactly on this whole concept, right? Which is that company and that organization has no sense of the leadership that you just described, that Jack Dorsey or plenty of other people have exhibited, in my opinion, and where there's just a complete and utter lack of the wrong kind of empowerment, there is a lack of the right kind of empowerment and the right kind of decentralization, the right kind of culture and ethos that permeate the whole organization. Because, look, I understand the motive of it, move fast and break things, because we're edgy and we're disruptive and we're tech guys and we're smart and we're young and the world is changing rapidly around us. That's all completely and totally valid. But like you said, Elliot, I mean, along the way, a lot of the things you're breaking are things that you actually need and things that are actually useful. And you're probably creating a lot of really unnecessary havoc, both in your own organization and in the broader society.
And there's like a time and a place where that may or may not be the best strategy for a given company. But overall, for most businesses, it's definitely not the right approach to take. Like, you can't treat everything as a commodity that you just ingest and spit out for the benefit of only shareholders. Like, I think, as I've tried to narrow my universe of companies that intrigue me and are worth my attention, I know with ESG, certain things tend to be popular, but I don't think of this from an ESG framework per se. I think of it in business fundamentals, but the best businesses to me really stand out for how they don't think that way in a lot of respects. How they approach, every little thing is really important, and how they, really don't want to break things because there are consequences. And, who deals with those consequences is also an important question. Which of your stakeholders are you willing to kind of push consequences on? I don't know. I mean, definitely, this idea of treating your employees above other stakeholders from Danny Meyer, you don't hear about too often in a lot of different companies. But it's so unique. It's so different. And obviously in hospitality, it has a little different role because that's like the face of your business, the face of your brand. But yeah, I mean, Kaizen is not about consumer-facing businesses per se, right? Toyota is one of the ultimate companies on that front. And, it was about how to build cars the most lean, efficient, and best way. And those cars tend still to this day, much longer than the cars that are not built with such a process. So I find that very interesting. And I do think the relevance is well beyond what might on its face appear to be the case. And speaking of like on its face, Phil, just like you, this book was written in 2006. I was told to read it many times along the way. I had even more recently been like, why might something written 15 years ago still per se be relevant, about business right now in this moment? And obviously certain things are timeless, but I always wonder if someone who wrote a book at the time they were trying to kind of broaden their own brand personally, whether it's, kind of timeless in that sense. And it is. It's really interesting. I'm so thankful Palmetto gave me the push to actually read it. And it's one of those things that as I read it, I like find myself constantly obsessing over. So yeah, I'd say go get it.
Well, I think any book that can stand the test of time is the number one test of whether it's any good, right? So I think a book that, can come out and be bright, shiny object for 1 year and land on a bunch of bestseller lists is great. And that's super impressive. But I often let those books sit there for a year or two and kind of see how they evolve, right? I mean, that we can all point to plenty of books that were all the rage, particularly in business at a certain period. And then after 2 or 3 or 5 years, it's like, wait a minute, every one of these examples is terrible. The concepts didn't really hold up. And so, whether it's a great work of literature or a business book or something like that, I mean, I often go back through and find that, and I actually started this effort some years ago where I picked like my top 10, somewhat arbitrary, but top 10 favorite books and went back and reread them. And then a lot of times I was rereading them for the third or fourth time. And I learned more from rereading those super awesome books than I did from, even the bestsellers of that current year. So I think there's something to be said big time in favor of these books that have really stood up for a decade or more.
Yeah. Well, I guess we're not reading Jack Welch's Way of Growing EPS anymore.
It's pretty astounding, isn't it?
Yeah. Phil, let's move on to your topic for the week.
Sure. So this is a little bit of a change, but it's similar to what we've talked about in a couple of regards in the past. So I came across this week in a couple of things that I was reading, and it's kind of a useful valuation shortcut that it's been useful for me over the years, and it pertains to the concept of duration. So I think we've talked about duration in the past, but for anyone who hasn't listened to that or anyone who's totally new to the topic, it's a fixed income concept, which is a weighted average period, at least the Macaulay duration that I'm referring to, which is a weighted average period of time, usually in years, of how long you'd have to wait to get the bond's repayment and cash flows, right? So think of it as kind of like the tipping point, and it's a measure of interest rate sensitivity as well. But you could think about a bond that is issued and then 1 second later immediately refinanced and repaid, so you get everything back right away. That would be a duration of 0, or you could think about a 0 coupon bond where you get nothing until maturity, and the duration of that bond would be whatever the maturity is, 5 years, 10 years, 25 years, whatever it is. So that to me has always been a really interesting concept, right? I mean, the more duration you're taking, by definition, the more risk you're taking in a sense, because the future is uncertain, right? None of us can predict with perfect accuracy or even any semblance of accuracy what the future holds. So one thing I've always liked to think about is this concept of equity duration, and the same concept, right? I mean, like we've definitely talked about, a bond-like mentality to valuing equities, which has some utility, right? It certainly doesn't pertain too much to, high growth, venture capital style investments, speculative investments. It has lots of limitations, right? And it can really limit you if it curtails your imagination and locks you into too narrow of a framework. But I think it can also be just a really good common sense check on where things stand. So one way that I like to kind of modify this is to just figure out, how long do I have to wait until I get roughly half the value of my investment back in present valued cash flows? So how many years would it take to recoup roughly half of whatever I'm buying today? So again, we've talked a lot about business first investing. That's certainly how I do it. I don't really care what the stock price is per se. That can get pretty silly and arbitrary. I really go look at the entire enterprise value and the entire equity market cap. So in doing that, I mean, you get to some pretty big numbers that can kind of reframe the debate for yourself a little bit more than the stock price. The stock price is X, but the market cap is $1 trillion. It doesn't really matter so much if we're talking about $100 in the stock price, if it's $1 trillion market cap, right? So that sort of thing. So anyway, I put together some hypothetical examples to run by you guys. And again, the devil is in the details here. So you have to. You can debate these assumptions for sure, right? These are not written in stone. They also don't account for, capital structure. They don't account for if there's some sort of hidden asset value play. I used a 6% discount rate just for argument's sake, because I think that's a relatively decent long-term historical rate for an equity market. It's not the discount rate that I use personally all the time, and it's not one that I'm recommending. I just sort of picked it as one that would be the least objectionable. And obviously you can play around with the coupons, right? The cash flows you're getting as the equity owner a lot. That is absolutely the trick. We'll see though, it's not quite as sensitive as you might think. And by the way, this also leaves half of the present value that you're paying, today's market cap, leaves half of the value beyond this point, right? This sort of arbitrary line in the sand that we're drawing. So anyway, I took, at least I wouldn't go beyond 15 years. Like if it took 15 years, I just jacked up the growth rate just to show how kind of crazy life gets. And I took a handful of companies. These are all companies that I do not own. I don't short anything either. So I literally don't have a horse in this race at all, just to use them purely for an illustration, right? So there's no implicit good or bad to be said here. It's just a purely thought-provoking hypothetical exercise. So if I took the first one that just popped up, these were just companies that were randomly in the news or on the screen in the past few days. Charter Communications, very well-run company. Current market cap's about $138 billion. And I used, by the way, for at least the first 3 to 5 years, however much was available, I used what I deem to be the best measure of owner earnings and free cash flow that's actually available to the owner of the equity, right? So this also gets into some complications where if you obviously don't really control it and the company can screw it up or they can make beautiful new investments with it, none of that is really captured. These are truly just excess cash flows available to the residual, which is what the equity actually is. So between now and 2025, FactSet has free cash flow to the equity going from a little over 8 billion to a little over 10 billion. So growing kind of a mid-single digit rate. And then beyond that point, I actually just cut it off and had cash flow dead flat at 10 billion for the next 4 years. And so it actually only takes 9 years to get back half of your present value of today's market cap of 138 billion back. All right, so you'd get almost 70 billion back by 2029 at these assumptions. And that incorporates a 2% compound annual growth rate in the free cash flow from today, right? A little over 8 billion to a little over 10 billion. So 9 years, like that's actually pretty good. I mean, again, this is not an investment recommendation. I don't own it by any stretch, but I generally like to look for companies that I can understand where I get half of the present value of cash flows back in the first 5 to 10 years. Just because beyond 10 years, the world is so uncertain. It's so hard to predict. It leaves so much on the table. Again, I violate that rule all the time for companies that I think are truly exceptional, truly have that growth potential, et cetera. But it's just an interesting thought. At the other end of the spectrum, a little bit bigger than Charter is Netflix. The market cap today is $250 billion. Here again, this is a company that's defied a lot of people's expectations, mine included. It's been a phenomenal success. It's exceptionally well run. They're very thoughtful about everything they do. I've talked about this a lot. I'm hugely impressed with a lot of the things Netflix has done. But let's look at the actual cash flows. So this year, maybe not so much in the way of actual excess free cash flow. The sell side consensus, again, giant asterisk there, goes up to $1 billion next year, $3.25 billion the year after that, all the way up to $9.5 billion by the end of 2025. So from zero to almost 10 billion in 5 years. It's quite a bit of growth. And then from there, I had to ramp it up 25%, 15%, and then basically 10% all the way through 2035. So that's a pretty massive compound annual growth rate. I mean, it would literally break the calculator because we're starting at zero. But point remains that, you have to put in some exceptionally high growth rates, right? I mean, you're talking about free cash flow compounding at least a high teens, low 20s kind of rate for 15 years just to get back half of your present value of the current market cap, right? So a little bit stretched. I mean, maybe not stretched. Who knows? I mean, again, I'm not making any judgment calls here. I'm just pointing out the math. Peloton, it wouldn't be a podcast without talking about Peloton. $41.5 billion market cap roughly today. I mean, here again, you're not getting back anywhere close to half of your present value of the current market cap inside of 15 years without some pretty massive assumptions, right? So you're talking about maybe 400 million of free cash this year if things go well. The sell side has it going all the way, has it more than tripling over the next 5 years. And then from there, you'd have to compound it from that starting point at least 14% a year through the end of 2035 to get back half of what you have. At the far end of the other side of the spectrum, I picked Verizon just because we all saw that Berkshire made an investment there. Interesting in some regards, right? And this was the shortest one in the bunch. It's only 6 years to get back half of your investment. So, and that's with a very modest 3% compound annual growth rate in the free cash flow. So a little under 20 billion this year, a little over 20 billion next year, going up to about 23 billion by the end of 2026. That gets you back over 112 billion, 113 billion against a market cap of 225. So pretty interesting, pretty impressive. Microsoft, another, tech giant, you can actually see a pretty clear path there, even though the market cap is $1.7 trillion, with only 7% growth in the free cash flows through 2034. So that's 14 years of free cash flow. You can get over $865 billion of present value of cash flow out of that company. Is 7% the right compound annual growth rate in those free cash flows? I don't know. That's a lot of cash. I mean, by the end of 2034, you're talking about 141 billion of future value of cash flows coming out of that company. So pretty astounding numbers, but that's completely plausible. I mean, that could very well happen. And then just to stir the hornet's nest to end on, I did throw Twitter in there because I knew that would get Elliot to perk up and pay attention because he's probably fallen asleep by now. But it looks like, and again, this is where he would potentially have a much different view of the actual cash flows, but maybe something on the order of $500 million of cash flow this year, free cash flow. The sell side has that going to well over $2 billion by the end of 2025, when most analysts stop publishing those numbers, at least according to FactSet. And there again, they'd have to grow it at about a 14% compound annual growth rate from that starting point. So over the life of this 15-year little experiment, that's a 21% compound annual growth rate in the free cash flows, just to get back half, right? So to get back about 30 billion of present value cash flows against a market cap of a little over 61. So anyway, look, there's some danger in doing this, right? It can shut your mind off to bigger and better explanations of what the future could hold. It could kind of lock you into being almost too risk averse. But at the same time, there are lots of companies that I didn't include in here because obviously the math wouldn't be helpful, that don't generate any cash and may never generate any cash. So you're really by definition holding a zero coupon bond where the only possibility you have of not just getting out, but getting anything is to get refinanced out. And in the equity market, that means somebody else paying you at what you paid plus a premium, or an M&A event or something like that. So you really do need to ask yourself in a lot of these situations, how many zero coupon equity bonds am I really comfortable owning? It's tough. And it just points out, like, if these numbers really have to pile up in a massive way, you have to be really comfortable that this business is amassing that value at a really high rate that exceeds your own discount value, whatever the discount value is you're using. It's not a definitive valuation by any stretch. We're not actually laying out the precise cash flows and trying to figure it out, but it's a very good expectations analysis, right? To kind of reverse engineer what the expectations are in the stock, right? So if you can make a credible case that Microsoft, even though it's $1.7 trillion and that's a big giant number, but you're like, no, wait a minute, these cash flows, starting from 50 or 60 billion, like they're going to grow way faster than 7%, then you could actually make a lot of money on the basis of that, right? But this is the kind of math I think is a really good, helpful check on the process. So what do you guys think? Is this overdone or is it useful?
Oh, I think it's incredibly useful. I think it's something really important to think about, in every one of my models. First off, like what you're talking about is much akin to a reverse engineered DCF, just sensitizing for a different variable than, necessarily starting with each of the KPIs. And, I think to an extent, it tells you the margin of safety if you're wrong, because you're focusing a lot on what the cash flows are. And that's the one kind of single source of truth that you do have as an owner of stock, right? At some point, a company that, even if they choose to generate zero free cash flow and invest, they could be a little more beholden to the market's estimation of duration. So you think about that right now. in this very moment. And what we're seeing as interest rates rise over the course of the last month and a half are longer duration equities, and those equities valued specifically as interest rate proxies. Here I'm thinking of stuff like the towers and the data center companies. They really get hit alongside a rise in interest rates. And so, I think it's something important to think about, both in terms of what factors you're exposed to and your margin of safety in a given security. So obviously I have to talk about Twitter, right? Twitter is a different beast.
I threw that in there for a reason.
Right? I'd love to know exactly which day you picked the estimates for. Did you do
I pulled them.
Or
I pulled them. Yeah, I pulled them down off of FactSet last night. So again, like you can, and again, this is where this experiment is only so useful, right? I mean, you really could sit here and play around with these numbers when you actually know the company, and it would make a meaningful difference. Now, I'll do this, right? So I started at about $500 million of actual free cash flow for 2021, going up to $2 billion. Let's double it, right? Let's start with $1 billion and go up, we'll go up to $3 billion. I mean, it adds like 22 percentage points of what you'd get back, right? So it would cut the time you'd need by 5 years, call it.
And just to be clear, in free cash flow, are you adding back stock-based comp, or are you not in this case, right?
Yeah, another great clarification. I don't know. It's whatever was, because I'm not a Twitter analyst.
Okay, so the consensus in there definitely would be adding back stock-based comp, but I think that number is decently light of what reality will be.
Okay.
That's an opportunity to kind of, when you're more informed about the stock or have a variant perception.
Exactly. Right.
I'd say a big part of why I asked you which day you took the estimates from is just before the Twitter analyst day. The average analyst was way below where Twitter guided to for the next couple of years.
Sure. I've seen that happen a ton too. The company that I've been the single biggest investment in my fund for 5 years, like it's almost like clockwork. Every year in the fourth quarter, the sell side estimate for free cash flow is still below what they've already posted for the first 3 quarters of the year. And they're profitable and free cash flow positive every quarter. So it's like, so these numbers are hugely flawed. It's truly just, this is a framework to play around with and
100%. So where I was inevitably going with it is, right, like you've already seen the estimates marked up meaningfully over the last week. But I think, because they are Twitter and no one wants to give them the benefit of the doubt, the average analyst is sitting below where, they've said their reality would shake out. And then, I did a Spaces the other night with a bunch of Twitter bulls. So if you want some like confirmation bias, that's what it was in a lot of ways. But effectively, I asked this question, is there framework aspirational or achievable? And depending on what you believe, obviously the analysts are viewing it as aspirational. I view it highly achievable. I actually didn't even have to change my numbers at all to get to that framework. And so where I'm going with this is I just quickly pulled up my model while you were talking about it. Over the next 8 years, I think the PV of the free cash flow is going to cover about 33% of their market cap. So I'm discounting
over how long?
Those. 8 years.
Yeah. So look, that was exactly what I was talking about earlier, which is like, I like to think about, those sorts of figures, right? Okay. If I can cover a third or a half over 5 to 10 years, that's a really strong anchor, at least in my book, for, the kind of certainty that I like to see in the world.
And you're summing free cash flows, right? You're not discounting them. So, here, like covering a third in a discounted way, I think.
These are all discounted. I mean, I applied a 6% discount rate to
all. Oh, got it. Yeah, I'm using 10 here, but that's.
Yeah. So look, that's why I said I would use a different number for my own purposes. I use 6 because I think some people would view 10 as being overly punitive, but I'm with you 100%.
Yeah, I love that concept. I mean, the riff I would have off it is like, when you look at a company like Verizon and you see how much free cash flow will cover their market cap over the next few years, the problem a company like that has is, very small changes in their operating model. And it could have extreme valuation changes. In contrast, I think the growthier companies, small changes in their growth as opposed to their operating model will have, it's going to be extremely sensitive. And which one do you think is more believable or achievable? Like it's one kind of risk for another. Um, Man, Verizon makes another bad acquisition. There goes a lot of market cap. So, I really do like the concept that you said about half of PV back within the first 10 years. It's just a really good way to think about like, if you have a long-term holding period, you're willing to see it through. If it goes wrong, like what's the least you could expect to be there for sure? And
Verizon's a good one, right? Because I did put that in intentionally as like an old stuffy dinosaur that obviously lots can go wrong. And I mean, to start with the obvious, right? I mean, with any company that has both operating and financial leverage, it's a double-edged sword. And so great, just because there's a lot of cash flow today. I mean, we've seen that play out. And this is where the whole
value extremely capital intensive, right?
Yeah, very capital intensive, right? So this is where the old value versus growth debate gets really stupid, because just because Verizon's pumping out a lot of cash today, and if the world stays as we so-called expect it to today, you get half the market cap back in 6 years. That sounds great, but there's lots that can go wrong there. And what the market is telling you is that they're nervous about it relative to Microsoft, right? And so that's where you have to come in as an analyst and say, no, I'm relatively comfortable with what Verizon's got going on for the next 5 or 10 years. And I think these cash flows are actually going to materialize. But yeah, look, I hate the term value trap too, but something that has optical appeal in that sense can often be the worst investment. So it's just, I think it's helpful to compare and contrast the two, right? And say, which bet am I more comfortable with? The creaky old bond with a relatively high current yield and a decent credit rating, but not bulletproof, or the, zero coupon, non-investment grade high flyer, right? I mean, and there's something for everybody. You just have to actually take the time to actually think through that analysis.
Yep, absolutely. Going from a 15p to a 10p is the same thing as a 30 to a 20, right?
Yeah.
And so the cheap stuff, they're similarly sensitive. It's interesting to think that, I think Microsoft is such a perfect example of where this market is today, because they are just spitting off free cash flow. They're growing. And, I feel like they've slipped through the cracks. Like if you think about what the market's done, from July to November, anything growthy absolutely flew. Maybe even you could say from July through January, growthy stuff flew. And from November through now, value stuff's absolutely flown. And Microsoft's largely been spinning its tires because it doesn't neatly fall into either of these factor buckets. And I do think, increasingly, when I think of duration and equity too, I think a lot about the factors that are driving things. And, especially in this moment where you see like a big unwind of the growth factor, each day I like pulling up on Koifin, the factor screen, and you can see exactly what's happening. So far as we're speaking, just in the last week, like the momentum factor is down 10%, but the small cap value factor is upwards of 10%. And so, these kinds of weird quirks and moments where, the pendulum swings from one to the other really matter a lot. And I love paying attention to which ones it doesn't matter to.
Exactly.
Something like Microsoft, right? It just doesn't matter. It's not part of this factor market. But that's just, one of the frameworks I like thinking about duration through. I am paying attention to some of these like equities that trade as duration stubs, like Equinix and Ameritower, like really interesting business models that right now are kind of in the eye of the duration storm that we're experiencing.
Yep. Agreed.
Yeah, I'll jump in. Just I don't know if to what degree the FCF numbers kind of include growth capex. Phil,
they should include it, but again, this is where you have to be the actual analyst, right? And why the numbers on the screen can be totally meaningless, because if that growth capex is creating more than $1 of value, it shouldn't be valued at $1. Or if it's destroying value, right? Or if it's only going to last 2 or 3 years and then free cash flow is going to explode. I mean, all those things. And again, so that's why the numbers, the inputs are very flawed by admission here.
Yeah, because I think, in fairness to Netflix or something like a Naked Wines, if a company is electing to invest in what they know to be, very high positive, high return projects, then, the reported FCF may not be as relevant. So that concept of how quickly you get all your money back doesn't apply as much, because they're just choosing to not give you that money back. They're choosing to reinvest it in the business. And just one thing that I kind of struggle with, or that's part of my thought process, when you have something like a Verizon, or let's say an oil and gas company that on paper would get you that money back quickly. If it's a situation where you actually could not reinvest that money in the same company because at some point it dies, then it's kind of a tricky one. If you think of, let's say, the Saudis running off their oil fields, if they just keep reinvesting into that, they're going to be left with nothing at some point. The only way that works is if you kind of take that money that you get from these cash cows and reinvest it into something that's going to actually grow cash flow over time. But then the question is, like, why do that in the first place? Why not just invest in those companies to begin with that are going to grow free cash flow? And do you know at what valuation you'll get to buy into those growing free cash flows when the cash cow gives you its coupons? So it's a tough one, but that concept of value trap is kind of ever present when you've got companies where they may not be around, but they're throwing off a ton of cash flow right now.
Yeah, look, it raises a great point. I mean, if you're running off your most valuable cash cow that doesn't have reinvestment opportunities and you put it all into WeWork and Greensill via the Vision Fund, it's not going to work real well for you. So, and look, I mean, Elliot raised a very valid point too about Verizon specifically, right? I mean, there's a lot of cash flow that's going to come out of this thing in the next few years, and what they do with it is going to be enormously important, right? I mean, this is why capital allocation and corporate governance really matter, because for a company like this in particular, I mean, the board and the management team are going to oversee an enormous percentage of the total capital employed in this business is going to be decided on over the next 5 and 10 years. And they could do well with it or they could do poorly with it. And human temptation in big organizations like this is such that you don't always get a great result, unfortunately. So I'm very leery of those types of situations where I don't have a lot of faith in who's calling the shots. And to your point, John, I mean, look, I think that's what's been so interesting about the development of the markets. I mean, I love this concept that, like, the public markets, it's faded in the past year or two. It doesn't seem to get as much attention, but this concept that, like, oh, you can't go public because the markets are too short-term oriented, and yet you have all these amazing companies like Netflix and Amazon that intentionally reinvested and didn't flatter their optics, right? So they made the long-term bet by reinvesting in the company at the expense of showing current earnings and cash flow. And of course, it paid off enormously for them, right? And you mentioned a company like Naked Wines, and that's exactly it. I mean, if you have a project where you know that the lifetime value of that project is higher than what you're having to pay in present value, of course you do that. And that actually is the best possible thing for a lot of management teams, because it takes broader questions of capital allocation out of the picture, right? They don't have to deal with it, right? They know this is their business. They know they're good at their business, and they just keep doing it. And that's a beautiful thing. I mean, it just, again, I think the only balancing act you have to trade there is, because that's worked so well. I've seen a lot of companies, at least, and not any of the ones we've mentioned today, but where they calculate the lifetime value of, let's call it, their customer. And it's just total nonsense, right? I mean, it's just total garbage. And
that's so true.
There's just no chance of ever recouping those numbers. And so you just have to be careful as to who's real and who's not. And the ones that are real and the ones that can say, I'm going to defer gratification here, so to speak, and I'm going to reinvest in the 5 and 10 year life of this customer relationship, God bless. That is a wonderful thing and a powerful business model. You just have to watch out for the pretenders.
Yeah, but I want to I do think with the real ones, you could tie it back to a lot of what we're talking about. So like Naked Wines, for example, I'm glad you mentioned that, John. They are, obviously trying not to make money right now, right? They're investing the actual earnings in the business, though they're not actual earnings. They're not reported as such because the investment comes through, sales and marketing, acquiring new customers. And when you think about that, there is a way where if you know and understand the unit economics of the business and you could figure out, to what extent they are reinvesting in growth as opposed to, maintaining their existing customer base, you could add up like how much cash flow they'll be reinvesting over the course of 10 years, just as you suggested, Phil, right? So you could think in present value terms on what they're reinvesting. And then, thinking about Buffett's retained earnings test, obviously, I'm not talking about retained earnings in the balance sheet sense, but the retained earnings in the sense of what they are reinvesting, whether they're truly achieving, ROI that's above your hurdle rate. So, I think all these concepts do tie together. There are ways that growthier investors could kind of deploy this. You should have a sense of, how much is investment versus how much is actual OpEx to support the business. And then, you could really apply the present value test in that way.
Exactly.
Okay, great. Well, thanks, guys, for another fascinating discussion. And thank you all for listening. We appreciate you being with us from week to week. Take care for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.